Counterparty risk, see, always remember, credit risk is of two types. Always. Credit risk is of two types. One is counterparty and second is country. And it is related to non-performance of the trading partners due to counterparty's refusal or inability to perform. So basically, if the other party is not able to give you the funds or whatever the job they have to do, so that then it is known as counterparty risk. Normally, such default happens in call money borrowing between banks since it is purely unsecured. So this, what do you mean by this here? That's why the main problem over here is call money borrowing between the banks. Now, what does this mean? Suppose if some bank needs urgent money, then it takes in credit. It takes on credit, udhari. Now, while returning it back, this generally never gets returned. Even banks do the default, okay? Because it is call money is generally between two banks. It is like that forward. There is no third party system in between. There is no third party. Suppose if bank A wants some money and bank B is ready to give, so it is the transaction is between these two banks only. That's why RBI has said that no more doing this business between yourself. Suppose if you want some lending or you want some loan, then you have to follow our system. There is a system called as TREDS. So through that TRED system, they follow it. So what happens? Everything gets recorded now. Earlier, what used to happen? All the banks, whenever they want money, they used to take it from the other bank without anyone knowing. So this is known as call money borrowing, urgent money. Okay, and this generally happens in this counterparty risk between the banks only. The starting point of entire Basel prescription came out of the counterparty risk only, which is called as Herstat risk. Herstat is actually systemic risk. Okay, it is systemic risk, but it started as a counterparty risk, which are ongoing in subsequent chapters. That's okay. Country risk. This is also type of credit risk where non-performance by the borrower or counterparty arises due to constraints imposed by the country. Okay, so here the problem is imposed by the country, like Afghanistan, right? Afghanistan, what happens? Means we give this, the party is very good, but the country itself has defaulted. So country itself is not paying you, or it has stopped the payments from outside. So in that case, it becomes a country risk. When the country does some imposition, then it's called as a country risk. Okay, hold on. Font size. Now, okay. Vinitha. Now, okay. Font sizes. Now it's okay now. Chalo. Country risk. Next. Operational risk. Operational risk means Basel Committee says all this theory is okay, but operational risk means what? Inadequate or failed internal process, people, or systems, and or from external events. So failed processes. If your process has a loophole, then it's known as failed process. Means in your loan process itself, the documentation, you don't take any specific documentation, then that is known as the failed process. Remember, process and system, these two are two separate elements. Process and system, these two are separate elements. System means what? Your computer system. Process means what? Your basic loan process, which we call it as SOP, standard operating procedure. So if your SOP has a problem, then this is known as failed internal process. Then strategic risk and reputation risk, though in nature of operational risk, are not covered under the definition of operational risk. Here, this question comes many times. Strategic and reputation risk is not a part of operational risk. So whenever we cover this strategic, this operational risk, these two names will always be reflected in your question. Strategic and reputation is separate altogether from this definition of operation risk by BCBS. BCBS means Basel Committee, okay, on banking supervision. Operational risk may loosely be comprehended as any risk which is not categorized as market or credit risk. So whatever is not market or credit, now this theory you can definitely read it. Only the logic behind this is process, people or systems or external events. External event means what? Flooding. Suppose if there is a flooding in your branch, then you can't service. So that is also known as the operational risk. Transaction risk arises from fraud, both internal and external. One sec, let me take it above. Arises from fraud, both internal and external, failed business processes, and inability to maintain business continuity and manage information. That's why we discuss something called as BCP, Business Continuity Plan. Every bank has this BCP, Business Continuity Plan. Okay. So it arises from what? Fraud, internal or external events, means fraud, external and internal frauds, and failed business processes. Compliance risk. Compliance is the risk of legal or regulatory sanction. So legal or regulatory means, suppose if I have to do some compliance of RBI and I don't do it, or any other country, not only RBI. Suppose if I have a branch of SBI in USA, so as per their local compliance, I have to follow their instructions, not my instructions. So compliance time risk is the risk of legal or regulatory sanction, financial loss or reputation loss that a bank may suffer as a result of failure to comply with any or all of the applicable laws. Now, basically remember, local laws, if not followed, you'll have a compliance risk. Okay. Nowadays, regulator, including RBI, attach lot of importance for this risk and hence are looking for compliance culture in carrying out this. Now, this all theory. Okay. Understand compliance risk, logic you understood, that's enough. Strategic risk. Strategic risk means what? We did this earlier. Adverse business decisions, improper implementation of decisions, lack of responsiveness to industry changes. Like I gave that example. Nokia, okay, gone. Nokia gone. What is the next one? That Kodak company gone. There are many others. Means why only that? Nokia and Kodak. There are many others. Banks. How many banks are gone? Do you know how many banks are gone? Many of the banks who are not able to perform or change the IT systems, many of the banks are gone. Now what happens in commercial banks? There is an advantage. What happens is, like Yes Bank. Yes Bank, this did not do, see this. Yes Bank had a major problem in 2017. Its share plummeted, means gone down. That was a strategic risk. Why? Because they didn't look into it that they were 68% in corporate finance at that time. 68%. Okay. Means out of 100 rupees of their loan, 68 rupees were given to corporates. Whereas the world was moving towards retail banking. So that was the basic problem. That was the strategic thinking. But that changed it later. So the advantage in commercial banks is, suppose if you face any problem, some other company buys you. Yes Bank was brought by SBI actually. SBI took a major share in SBI, in Yes Bank. Okay. So it was kept up to 3 years and there was a lock-in for 3 years. That's okay. Chalo. Reputational risk. This risk would affect the bank because of crystallization of credit, market, or operational risk. See this. Reputational, because of crystallization of credit. Crystallization means what? Actual that risk comes on your head, like the bank guarantee. Okay. So whenever there is any bad news about you in the market, because of some guarantee which you have given or any this promise you have done, so whenever that risk comes to your head for payment, that is known as this crystallization risk, and that gives rise to this reputational risk. So reputational risk is an indirect risk. Remember, reputational risk is an indirect. Negative public opinion. The risk may expose institutions to litigation, financial losses, and decline in customer base. Okay. Model risk. Models are designed to predict values of variables for which it is specifically designed. Values of a given variable would depend on one or more parameters which influence the value of the given variable. Now, look at this. Model means what? Suppose if I write any equation, y equals to a plus bx. So that is basically a model. But if that equation itself is wrong, then that gives rise to this model risk. The parameter and specific value would have a relationship which may be mathematical or may be derived statistically from the set of observed data. Now this is all theory gyan to you, okay? Forget this. Don't you can read this later. Okay. So values predicted through models when compared with the actual observations may show deviations, gaps between the predicted value and the actual value. So this is known as model risk. Means like I said, if I give you the equation y equals to a plus bx, in ABM we saw it just now. So if I give you the equation y equals to a plus bx and you find out the values of y based on this equation, but if this equation values of a and b are wrong, then what happens? My entire set of values for y get wrong. Okay. Similarly, we follow this in our banks also. Suppose if our basic structure of any product is wrong, then entire future things about that product go on means we go on making the mistakes in that. Okay. Climate risk. Climate risk refers to the potential risk that may arise from the climate change or from the effort to mitigate climate change, their related impact, and the economic and financial consequences. Now, climate risk, you'll say, sir, what have we to do in banking? How does climate risk affect the bank system as such? It will definitely affect. Remember, we all give the agri loans. Now, agri loans due to the climatic changes, there will be huge problem in those agri loans. So that will affect my bank's position as such. So that's why climate risk is not a simple risk. Understand this. It has become a major risk now. Chalo, let's start with today's topic now. Yesterday we did one numerical. Day before yesterday we did one numerical. Today we'll be doing one simple numerical and then we'll start with the theory part today. This is very simple and it comes for 1 mark. 1 mark. Okay. Bank having 1 day VAR of 10 crores with 99% confidence interval means that there is only one chance in 100 or 2.5 chance in per year based on 250 working days. The daily loss will be more than 10 crores under normal trading conditions. Now, what does this mean, this line? See here, in exam, you'll get a question on this. One line question. They'll ask you that bank is having 1 day VAR of 10 crore with 99% confidence. Okay. So in a year, how many days the portfolio will be or the VAR will be more than 10 crores? That will be the question. Now look at this. See this 10 crores, this VAR is of 10 crores and 99% confidence. Means what? It means that my bank, if my value at risk, if my VAR equals to 10 crores, then my bank is okay. Bank is okay. Okay, bank is saying okay, 10 crore, that much VAR we can definitely bear if there is any loss. Only the problem is if this goes beyond 10 crores, means if it goes to 11 crores, then it's a problem to the bank. So what is the rule given? 99% confidence. What do you mean by 99% confidence? It means that in 100 days, now look at this, 99%. Percent means what? Upon 100. Okay. So out of 100 days, 99 days, my risk is only 10 crores. So look at this. Out of 100 days, 100 days total. Okay. 99 days means this 99 days. My VAR is 10 crore. So what does it mean? For 99 days, it is 10 crore. So 1 day it will be what? This 1 day remaining, it will be what? It will be more than 10 crores. Now this is the problem to my bank. Okay, this is the problem area. Okay, so what happens over here? So in 100, if I am having 1 day, now look at this equation now. This make this 100 check with this 1. Okay, So in 100, I am having one day where my risk is more than 10 crores. So if I want it for a year, so in a year, how many days are there? In a year, there are 365 days. But in problems, they give 250 working days. We want working days. Okay. So although there are 365 days, but working days are only 250. So in out of 100, one day I'm having this higher risk. So out of 250 days, for how many days will I have this higher risk? So it will be more. So this is known as direct proportion. 250 into 1 upon 100. So it will be 250 into 1. I'll multiply this upon 100. So what is the answer I get? 2.5. So for 2.5 days, look at this. For 2.5 days, my risk will be more than 10 crores. Means in a year, for 2.5 days, I will have a risk of more than 10 crores. And this is how we solve this. Now, suppose if I ask you the same question, okay? Now, who can give me the answer? The question is, I'm having the same figures over here. Only the 99% I'm changing it to 90%. 90%. 99 I'm changing to 90%. Now tell me, in a year with 250 working days, how many days my bank will be in a problem? With 90% confidence, in a year, for how many days my bank will be in a problem? Who can give me the answer? It will be 25 days, correct. Why? Because out of 100, I'm having 90 days okay. So 10 days I'm having the problem. So out of 100, 10 days is the problem. So out of 250, it will be what? 250 into that 10 upon 100. So 25. Okay. So this numerical is asked for 1 mark. Now everything is theory now. Today everything is complete theory. No numerical. Yesterday, day before yesterday, we did huge numericals, very tough ones. Today we'll be doing only theory. This is an important formula, and sometimes they ask you this, or they give you all these figures: yield, volatility, BPV, and yield and price. So all the things are, this is upon, this is upon. So the formula is price volatility. If they ask you, price volatility equals to yield volatility into BPV into yield upon price. So all the three figures will be given to you in exam. Given to you. Yield means, yield volatility means what? How much volatile my yield is. BPV means what? Basis point valuation. These figures will be given to you, and you'll be only asked to find out this price volatility. Yield is also can be found out. Here, yield is simple: coupon upon price of that bond. Okay, coupon upon price. But in exam, they will give you everything. All the three figures will be given to you. Okay. Main approaches to calculating value at risk. Again, here, as I told you today, only theory, nothing more. Okay. So main approaches for calculating VAR: the correlation method, also known as variance or covariance matrix method. The change in the value of position is calculated by combining the sensitivity of each component of the price change in the underlying assets. Now correlation we did it in AVM also. So the change in position is calculated by combining the sensitivity of each component of the price changes. So price, there should be only be two variables which are always done in correlation or always matched in correlation. Okay, so that's why price changes is one, and second is this, the change in the value of the position. So change in value and price changes. So if correlation method, main question in exam will be this: what are the approaches for calculating value at risk? So you need to answer this: correlation and historical simulation. Calculate the change in value of a position using actual historical movement of the underlying asset, but starting from the current value of the asset. Means we just go on checking the historical movements, how the movement of this stock or how the movement of this commodity has happened. For example, suppose if I check this, let me show you only. Let me show you. Look at this. Suppose if I'm having this graph, historical change. So what does this graph show? This graph shows the changes in Nifty prediction, Nifty values. So what does it? From this you can definitely judge. Suppose if I ask you, looking at this, you'll definitely judge that it will be somewhere going like this, top. Okay. So this is known as historical predictions and historical assumptions. We'll check it from the history and go further, and then we can predict. Okay. Similarly, we just did it in ABM also, isn't it? Time series. This is the time series numerical actually. Hold on. Yeah. So now historical done. Monte Carlo simulation. This is the most favorite question of IIBF. Most favorite question. They always like this Monte Carlo simulation. It calculates the change in the value of the portfolio using sample of randomly generated price scenarios. Remember, Monte Carlo means the word scenario should be there. Monte Carlo name means scenarios. Here, the user has to make certain assumptions about the market structures, correlations between risk factors, and volatility of these factors. He is essentially imposing his views and experience as opposed to the naive approach of historical simulation method. Now, what do I mean by this? Look at this. Scenarios, important word, means what? What will I study? Let's say, suppose tomorrow I am studying this share market, Nifty stock market today. So how will I study it? Suppose if repo rate of RBI, repo, repo increases by plus 2%, then where will my Nifty lie? If repo decreases by minus 2%, then where will my Nifty lie? So I'm considering various scenarios and then finding out the answers. So Monte Carlo simulation means randomly generated price scenarios. Here we go on filtering the data. From exam point of view, you only remember using the sample of randomly generated price scenarios. This is an important line in Monte Carlo simulation. So it calculates the changes in the value of the portfolio using sample of randomly generated price scenarios. Limitation of VAR. VAR is not worst case scenario. It does not measure losses under any particular market condition. VAR by itself is not sufficient for risk measurement. So, if they ask you here, they have not asked this question up till now in exam. What is the limitation of VAR? They have not asked. But if you have a hard luck, you will be asked over here. So, main problem is it's not a worst case scenario. VAR does not consider if everything goes wrong, then what will happen? VR just checks the fluctuations. See this, it just checks the fluctuations over here. Means, suppose if this is my mean, so my VR will go on checking this, the difference between this and this. But if sometimes due to COVID, if something happens, then it is gone down. So this is COVID. So VAR does not consider this COVID situation. So that is the problem. Worst case scenario is not considered. It does not measure losses under any particular market condition. VAR by itself is not sufficient for risk measurement. VAR uses past data to compute volatility. Obviously, VAR here, you can't, while calculating any future data or future predictions, you have to get through the past data. Different methods are employed to estimate volatility. So these different methods means what? Everyone will have their own formula. Every bank will have their own formula. So that's why different methods it said. One of the methods is arithmetical moving average and other is exponential moving average, EMA. Now what is the difference between these? You need not go into details, but computed from historical time series. Arithmetic moving average means what? I'll go on just 1 plus 2 plus 3 upon the whole upon 3. This is arithmetic moving average. This is known as arithmetic moving average. I'll just add these numbers and divide by 3. But what is exponential moving average? Exponential means here it is like this. Look at this. Huh? When I have to find out the exponential moving average of 1, 2, and 3, I'll do it like this. E raised to 1 plus e raised to 2 plus e raised to 3. Exponential means e. Remember this e. Okay. Now nobody is going to ask you this in exam. They won't be asking you, but you must know this. In this exponential moving average, the volatility estimates rise faster to shocks and decline gradually. This is an important line from exponential moving average. The volatility estimates rise faster; they go up more, but they decline slow. So, in exponential moving average, always remember if the question comes like this, something related to this, so it will be rise faster and get down slow. Conditional VAR. This is an important definition. Now, there is no practical use of this, but from exam point of view, you have to remember. It is also called as expected shortfall method, ES. The measure considers severe losses of the financial system beyond VAR. So whatever I'm testing, like the COVID situation I told you. Suppose if this is my graph and due to COVID it happens like this. So here beyond VAR, what was my VAR? My VAR was up to this. But what happened in COVID? Everything went down. So conditional VAR means it checks beyond VAR. Okay, remember this. It checks on. This is an important line from your book, which I have taken it down. Otherwise, this topic is very big in your book. Okay. So what are the methods applied? See here, back testing and stress testing. Again, these are again the important definitions which are asked. Back testing is a process where model-based VAR is compared with the actual performance of the portfolio. See this, actual performance and model-based. Now, what do you mean by model-based and actual? See here, this is same as that of those who have done ABM. ABM, right? ABM we did is normal distribution curve. This was known as population mean. So model based comes over here. This is model based. Whatever is the population mean is this model based. And actual performance means whatever I do the actual sample. So this is back testing. From exam point of view in BFM, they won't be asking you anything that this normal distribution curve or anything. What you have to remember? Model based compared with actual performance. Stress testing essentially seeks to determine the possible changes in the market value of the portfolio that could arise due to non-normal movement in one or more parameter. Non-normal means what? Non-normal movement means what? Take it simple. Russia-Ukraine war. Did anyone expect? Russia-Ukraine war, when it happened, the whole economy was on a problem, world economy. The this inflation in UK was around 13% at that time, 1.3. In US, it had gone to about 6.5% roughly. In India, we controlled it to some part, but then also it had went up. So stress means what? Stress testing means whatever has not happened earlier, that can happen. So that is known as stress testing. Back testing means we just check the history and compare our results with the history. But in stress, we don't have history. It is something unknown which has happened. That's why we use stress testing over here. Stress testing covers many different techniques. The four discussed here are listed below. Simple sensitivity, scenario analysis, maximum loss, and EVT, extreme value theory. Now, all these four are discussed over here. Simple sensitivity test. You have to remember these names because they might ask you this question. Stress testing methods are. So, what are the methods of stress testing? These four methods. Simple sensitivity, scenario, maximum loss, and EVT. So what is simple sensitivity? A simple sensitivity test isolates the short-term impact on the portfolio's value of a series of predefined moves in a particular market risk factor. Now isolates, remember this. This word isolates. Once you get this word isolate, it must click that it is simple sensitivity. Or in the exam they'll ask you simple sensitivity test means. Then whichever answer has this word isolates is your answer. And that will be the only checking point over here. Whichever answer has the word isolates, okay, that will be your answer. So simple sensitivity test isolates the short-term impact. Scenario. A scenario analysis specifies the shocks that might plausibly affect number of market factors simultaneously if an extreme but possible event occurs. So specify the shocks that might plausibly affect. Plausibly means surely. This is known as plausible, sure, or but to do, will happen. So the shocks that might plausibly affect the number of market factors. So what all factors will be affected because of some shock like Russia-Ukraine war, because of some shock like COVID? What all factors are changed? So that is known as scenario analysis. So this is same as that of scenario is similar to that of Monte Carlo. Monte Carlo, similar. Okay. There also scenarios are considered. Here also scenarios are considered. Okay. Maximum loss. A maximum loss approach assesses the risk of a portfolio by identifying the most potential damaging combination of the moves in the market risk factors. So most potentially damaging means maximum loss means again we go to the this extreme what conservative approach. Consider all losses and no profits. Okay, no profits. This is generally followed in this maximum loss theory. So if I get all the losses, then what will happen? EVT, extreme value theory. Extreme value theory is a means for to better capture the risk of loss in the extreme but plausible possible circumstances. So better to risk of loss. So whatever risk of loss may happen in extreme but plausible circumstances. Now there is an important word in extreme value theory that is known as tails. And in exam for EVT, they'll always ask you this word tails. Tails. Okay. EVT is a statistical theory on behavior of tails, a very high and low potential values of a probability distribution. Now, what do you mean by this word tails? Okay. Have you seen anywhere? What is this word tails? Actually, from where this word tail has come? Do you know? See this. The tail word is like this. The logic behind this tail word is. Have you seen any that what do we call that? Lizard. Lizard. Have you seen that lizard? Lizard. What happens if you hit that lizard on the tail? What happens to that tail? Suppose if you hit a lizard on the tail, what happens? Can anyone tell me? What happens? Suppose if you hit the lizard on the tail, what happens? The tail gets. Anyone? The tail gets. What happens? Haven't you seen this? In practical life, we see many times. Right? The tail gets cut, it gets separated, isn't it? The tail gets separated, it disconnects the tail. Now, this is the basic logic which is applied in this finance also. What do? They try to separate the event from the after effects and always look at the tail. How does the tail move? If you look at the tail, it will move from in vast means usually it will move. It will move like this, like this. It will go on moving. It will touch the extreme ends. You check the tail of that lizard. Whenever it gets separated, the movement of it is very high. So this is known as a tail event, and it has actually come from that. This extreme value theory has actually come from that. It says that whenever there is an end of any cycle or whenever there is any end of any event, so the after effects are more during the end season. For example, I'll tell you, during Corona, COVID also, what happened? First wave was danger, but second wave was more danger. It was because it was coming to the end. Okay, so second wave was more dangerous as compared to the first wave. So that's why they said that whenever we are at the end of any event, so at that time the loss will be more, and this is known as the tail event, and this is known as the EVT, extreme value theory. Models of analyzing stress testing. Now again theory part. appropriate and duly approved model control and certification policy. Now, what are the models of analysis stress testing? Now, this question, if it comes, they'll give you three options over here, and fourth option will be all of the above. So, if the models are asked for of analysis stress testing, appropriate and duly approved model control certification, fully documented financial models. So, documented, remember this word, duly validated by designated person. So designated person means anyone who is given the authority to validate this. Generally, this happens in banks using the MD level, using at the MD level, or there is a separate ALCO team. So that ALCO team is given this validity. Okay. Risk of trading liquidity is managed by avoiding large market share on in any given type of asset. Infrequent trading instruments, instruments with unusual tenors, and one-sided liquidity in the market. Now, what is this risk of trading? Now, I don't know why. Means here, one thing you understand what IIBF is doing. Okay, what IIBF is doing. This is all given to you about trading. Do you anytime see trading in your life, practical life, in as a banker? You never see this. So all these things for a practical banker who's doing a banking on a daily basis, these things are of no use to you. Then why have they given? They have given because this course CAIIB is common to all, to your retail banking also, to your this corporate banking also, to treasury also, to anyone. So that's why this BFM main part in BFM is of treasury only. I don't know. They assume that you are working in treasury. Means the way they have written the book, I feel all of them feel that you are trading on a daily basis in the market. You know all that. What is call? What is option? How does it work? It seems IIBF feels that. That's why if you look at the book, you'll see the difference. They have given many things as assumed. Okay. So what is risk of trading liquidity in risk of trading liquidity is managed by avoiding. So what should we avoid? Large market share in any given type of asset means what? This is similarly followed in the banks also, isn't it? Don't give loans to a single sector. Infrequently traded instruments means we should not trade in those instruments which are not traded. Similarly, in markets also, share market also, those of who amongst you, if you have brought some shares which are not traded in the market, you keep them for your lifetime, and you don't get the results at all. Instruments with unusual tenor, this generally happens in this bond market. One-sided liquidity in the market. One-sided liquidity means what? Funds go on coming in the market. Now, presently, if you look at the stock market in India, it is going in the same direction. One-sided liquidity. Has anyone invested amongst you in stock in shares? Anyone? No. If you look at this and anyone is invested, they'll find that last 1 month it is a huge upside. Huge upside is going on. Okay, because of why? One-sided liquidity. Everywhere funds are coming in. So that is always a serious issue. Okay. Someday this whole market will come down by around 1000 Nifty points. 1000 Nifty points means roughly it may go down, it will touch that 20,000, and from 20,000 it might reach to this 19,000. 1000 points straight fall because too high. Okay, chalo, move on. We are not here to discuss stock market. We can arrive at VR limit once we know the confidence level and its corresponding Z scores, that is standard deviation, which is arrived at from a normally distributed curve, bell-shaped curve. So, what this is again the theory part which you should remember from the exam point of view. But one important part is this Z score. We get it from Z score is also called as this standard deviation. This is why I have written this line over here. This is from your book only. Huh? it corresponding Z score and standard deviation which arrive at from the normally distributed bell curve. So this we have done in our ABM while doing that sampling distribution. So there we have that Z value. From Z value we find the probability. So that probability is known as is from this Z scores. And this Z score is also known as standard deviation in terms of treasury only. Huh? Risk mitigation strategies. Remember whatever I have given it over here. These are the important points from your new book. And mind it, if you get these new books correct and if you get these correctly over here, then it becomes easier in the exam also. Okay. One sec. Let me remove this. This is not module C. One sec. Let me remove this. C. One second. This is all module B going on. Okay. Yeah. So risk mitigation strategies. Strategies using sensitivity measures. Say a portfolio of two bonds A and B with BPV 675 and 205 respectively. The BPV of the portfolio would be the weighted average of BPVs of all the bonds in the portfolio. Therefore, the BPV will be what? 675 plus 205 upon 2. Now, if we intend to reduce the risk of this portfolio, we may add another bond in the portfolio such that its BPV is less than 440. Say we added another bond in the portfolio. The BPV of the bond will be reduced to 361.7. Now, what do you mean by all this? And why have I taken it over here? Okay, why have I taken this? This is a simple numerical. Okay, what is this numerical? See this, two BPVs are given. Now, what is BPV? Basis point valuation. Means what? What is basis point valuation? It means that hundredth part of 1%, that is known as BPV. Basis point valuation means hundredth part of 1%. This is known as BPV. Okay. So suppose if I am having a portfolio, what do you mean by this? We have studied this in our one of the earlier topics where I gave you that two things. One was that modified duration and second one was this BPV. So the BPV of the portfolio, two BPVs are given. Two BPVs means 675 and 205. Means what? Two BPVs means what? If there is a change in 0.01%, see this 100th part of 1% means 0.01% of the interest rate, repo rate, let's say. If it increases by 0.01%, then bond A, the value of bond A will reduce by 675 rupees. Suppose if repo rate goes up by 0.01%, then bond A will go down by 675, and similarly bond B, it will go down by 205. Now if I want to find the BPV of the portfolio, then what is it? It's very easy. 675 plus 205 upon 2. Okay, average. So this is the average which I found. So now what do I do? It's similar to, suppose if you are having some imagine you are having this bond. One is having the BPV of 675, other is having the BP of 205. So the average comes to 440. Now the 675 BPV is too high if you feel. You want to reduce the portfolio BPV. What will you do? You'll take that another third bond. This is bond A and B. Now you'll buy a bond C. Third bond C over here, which will have a BPV of, let's say, 300. Let's say, okay. If it has a BPV of 300, then what will happen? The average will again go down. 675 plus 205 plus 300 upon 3. So it will be definitely less than 440. And that is what the point is. We may add another bond such that the BPV is less than 440. Suppose if we intend to reduce the risk of the portfolio. So this question is asked to you. What do they give you? They'll give you all this history, this part. And the question they'll ask you is, if we intend to reduce the risk of the portfolio, what will we do? This will be the question over here. We may add another bond in the port, and this is the answer, where the BPV is less than 440. Okay. Strategies using correlation measures. The portfolio is a portfolio is long on stock A and short on stock future A, stock future of A. If the price of the stock goes up by rupees 10, the stock future would go up, may not be exactly by rupees 10, say rupees 9. The portfolio will gain rupees 10 on account of the long position, but it will lose rupees 9 on account of the short position. Isn't it? So simple. Understood? How many of you have understood this line which I have given, which is mentioned? Remember, it's from your book, huh? It's from your book. How many of you have understood this? That it will go up by 10 and it will go down by 9. It will lose 9. Has anyone understood this, or just saying yes? What do you mean by this? Yeah, everyone? If you have not understood, no, not an issue, isn't it? Because this is totally new for you guys. Many of you have not done any options or any market investments up till now. Have you got this? Whatever is written over here? Hi, am I audible? Hi, hi. See, here it's like this. That's what I say. In the book, what do they say? They think that you all are traders. Traders. Daily doing the stock market operations, buying call put, and then they'll give you this sentence. It's like this. What do you mean by this? Long on stock A. Long on stock A means basically I brought a Reliance share. Let's say Reliance. Okay, I'm long. Long means what? I have brought it. Long means what? Buy now. We always buy now in long. Okay, and then sell later. That is long position. Sell later. That is known as long. This is long position. Okay, so I have brought Reliance at 2500, expecting it to go to 3000, and then I'll sell. So I brought it right now and I'll sell it later. So this is my long position. Now what has happened? I'm short on the stock future. So Reliance future, this is a stock. Here, there are two things always. One is a commodity itself, and second is the future of that commodity. So I brought the long position over here, but I brought a short position on the future. So I'm expecting Reliance to go down in this future. Why am I doing the reverse transaction? Suppose if tomorrow Reliance from 2500, it should go to 3000, then I learn. But suppose if it goes down to 2000, what will happen? I lose. So that's why what do? I'm in a hedging position or in the this what derivatives position. See, this stock future means in the derivatives. Always remember, the combination always goes like this. The combination moves in this form. The combination in any commodity, any banking, any trading, any stock market, any bank thing, it goes this way. One is commodity, and second is the derivatives. They should always go hand in hand. Always. Suppose if you buy the commodity, you should always buy the derivative. This is for hedging the risk. Risk mitigation, we call it. Mitigation. Mitigation means if this stock value goes down, then what? If I brought the Reliance at 2500, but if it goes down to 2000, then what? So there I buy this short position, and that is known as future. Either I'll buy this in future or I'll buy this in option, anything. Okay, but I'll buy this short position. So now what happens if it goes from 2500 to by 10 rupees? So if it goes from 2500 to 2510, so my stock goes from 2500 to 2510. So I earn rupees 10 in this. But whenever I brought this future over here, I'd shorted it. Means I expected it to go down. So if I'm expecting it to go down and I brought this future over here, then I'll lose if it goes up. Whenever I'm short on any position and the commodity goes up, yesterday we saw that. Suppose if I'm short on any position and that commodity value goes up, then I lose. So here what will happen? If I brought this, whatever this future is, at whatever rate it is, let's say I brought it at 100 rupees. So this future value will go down by 9 rupees. So my value will be 91 over here. So here I have gained 10 rupees and here I am losing 9 rupees. This is what the meaning is. Always remember commodity and derivatives go hand in hand. They should always be brought together. No commodity should be brought in a single manner. If you don't buy derivatives, then you are at a huge risk. Okay? Yeah. So whenever you are long on any commodity, you must be short on the derivative. Whenever you are short on any commodity, you should be long in the derivative. It should always be the reverse thing. Okay? Chalo, we'll stop over here. Tomorrow we'll be starting another part. Okay? Chalo, bye everyone. Saturday we are having the class in the morning, morning 8 to 9. Remember, I have told you now, Saturday class is in the morning 8 to 9. Okay? So bye everyone.